Hi, good morning all, and thank you so much for joining this exclusive webinar. My name is Ashish Asthana. So today we are doing this exclusive session on the insights into building a mutual fund portfolio. Right? This is a topic wherein we would be discussing primarily on what is the current outlook of the market, how does the market we are looking forward, what are the insights. This exclusive session we are doing for Tata mutual funds as well. So just for your information, guys, we have a great personality with us to talk about on this session, Mr. Rahul Singh, who is CIO of Equities at Tata Mutual Fund. Right. So, Mr. Rahul, we welcome you on our show, and thank you so much for taking out time out of your busy schedule. So, all our viewers are awaiting to hear from you. Basically, how does the market is looking forward? What are the sectors that they should look forward, and what, especially as a Tata Mutual Fund, what specific schemes or plans that you will be having? So, over to you, sir.
Thank you and welcome everyone, and I hope all of you are staying safe. I have resumed office today, so this is a good day to have a call with you, and I've come after a gap of almost 3 months. So I think what I will do is obviously talk about the market in general, some of the sectors which we like, what we have been doing in our portfolios, what makes sense in the current scenario, which which category of funds make sense. And also, I think somewhere around that time, somewhere in that process, just talk about earnings and valuation, because I think one of the key questions which you want to understand, I'm very sure, is that we have seen the bottom already. And I think I'll try and give you some framework in which to understand that process. So let me try and run through your presentation. It's a very brief presentation, 8-10 slides, and then post that for the next 15 minutes. I'll be talking 15-20 minutes, and after that we can take Q&A. So are you able to see the presentation?
Presentation is visible, just you need to full screen it.
Yes, I will do that. Yeah. So yeah. So as I said, I will talk about earnings outlook and valuation, what changes we have made in our portfolios, what kind of structural shifts across sectors we have made in our portfolios, and then also talk about some of the longer term themes, which I think have been pretty significant but little less understood in terms of what impact we are seeing on the China plus one strategy, also the fiscal package, as well as the long-term reform measures which the government has taken. So I'll talk a little bit about that briefly, and then end with the schemes and category of funds which I think make more sense for the investors. So let me start with a slide which I have picked up from Kotak research team. Obviously, we can pick up any research team, but I thought let me show this. Most of the estimates are very similar for other research houses also. But what I wanted to show here, and I think it's very important to realize, is that if you look at the top two lines, the black line and the orange line, these lines are the Nifty EPS forecast for fiscal 21 and fiscal 22. So if Nifty were a company, if all the Nifty 50 companies were to be combined and made into one company, then what would be the earnings looking like? And you can see that for fiscal 21, the earnings have been cut from roughly about 675, 680 rupees in beginning of January, February, to about 560 today. Similarly, if you look at the look at the fiscal year 2022, the earnings have been cut from about 800 to 700 already. Now, why I'm talking about this is I think the fiscal year 21 numbers have continued to get cut. So that 564 rupees we have no idea whether it'll come down to 475 or whether it'll come down to 500 and so on. But I think what is very clear is that we need to focus on fiscal 22 because fiscal 21 is becoming extremely challenging to forecast. And therefore, what we have done is what we have thought. What I think is important is that if you look at fiscal year 22, that will decide how the market will behave now. At 10,000 Nifty, I think what happens in fiscal year 22 becomes more important. And I think in that context, what I wanted to show you was a nice kind of a schematic which I made a couple of weeks back or almost 3 weeks back, which talked about the fact that there are two scenarios as far as the virus is concerned. One is the smooth lockdown removal and no second wave. And the second scenario is that you have to live with the virus. If you look at the first two boxes on the right side. Now, it's becoming more and more clear that we have to live with the virus. So there will be a staggered lockdown removal. There could be a second wave. So in that scenario, it was very important that the fiscal package was a significant 4-5% of GDP. And what the government has announced so far, if you take out the RBI part and if you take out the contingent liability part, the actual fiscal stimulus is only about 1 to 1.5% of GDP. So clearly it's a modest fiscal package. And I would think that there is therefore continued risk of further earning cuts or further earning reductions on the chart which I showed you here. So I would not be surprised if this 564 rupees which you are seeing the black line for fiscal year 2021 comes down to 500, and that 697 which you are seeing for next fiscal year comes down to about 650. I think that is what we have to work with. Now, why am I showing you all this? I mean, why are we getting into this very analytical kind of discussion? Is because I think it's important. Because when we get asked questions like what is the bottom, I think it's important to realize that if we have to look at next year earnings of 650 and apply a multiple of let's say 17 times, which is an average valuation multiple for the last 10 years, then we get roughly a 10,500 kind of a Nifty as a fair value. So clearly at 10,000, 10,200 Nifty, we are coming close and close to the what we think is the fair value, given the volatility is going to be there. So that is like really, let me put it this way, that's in the short term, I think the market is trying to price in fiscal year 22 fully already. If you go back and see what was the bottom of valuation in 2009, it bottomed at 11 or 12 times, PE multiple. But I think the key difference between 2009 and now is that the bond yields are much lower. So I don't expect the valuation bottom to be 11 times. I expect this time the valuation bottom to be not less than 13 times. And if you take 650 as the EPS for next year and apply 13 times, you come to 8,500 to 9,000 as a Nifty level. So my sense is that from a bottom perspective, 8,500 to 9,000 is where the valuations will bottom if we do correct. I think at the current point of time in the market of 10,200, I think the downside risk is more than the upside risk. Can we correct 5-10% from here? It is entirely possible. And the reason may not be only domestic, the reason can be global also, because let's not forget that the US markets have had a phenomenal 2-3 month rally, and things are looking a bit overheated there, the kind of stocks which are going up. So if US market reacts, we will also react. So it need not be a domestic reason. It can be a global reason which can also take down the markets. So my own sense is that a 10% correction one should be mentally prepared for. It may or may not happen, but at this point of time, what can be said is that the downside risk is more than the upside risk, and the markets will remain volatile because let's face it, there are global risks, as I mentioned. There is also a risk of US elections, where if Trump loses, which at this point of time the trend analyzes, it will be bad for the markets. It will be not so positive for the corporate sector in US, and that could also lead to some amount of nervousness in the markets. As far as India is concerned, as I have said, given that the fiscal package was not very high, I think the risk that we keep seeing some earning reductions is continuing. So what do we do in this scenario where the markets are likely to be volatile and maybe range bound between 9,000 to 10,500 Nifty? What have we done? I mean, how do we manage money and how do we redeploy or our funds into sectors which protect this downside is what I wanted to cover next. But before that, this is an interesting chart, because the other question is that how are we sure that we will not form a Nifty, or how are we sure that the bottom of 9,000 will be hit? Whether it will actually be hit or not is dependent on also how the FII selling activity picks up from here. And if you look at today, India is trading at a 30-35% premium to emerging markets. It is not very high, but can that come down to 25-30%? I think that possibility is what we are talking about. But once it comes down, once India's premium comes down to 20-25%, beyond that, there is no further selling which you see from FIs, because all said and done, our market offers great diversity in terms of the number of sectors and the quality of companies. So I would think that even if you look at this chart and let's say figure out, let's say if there is a 5 to 10% correction, our valuation premium to other emerging markets will come down to a very reasonable 20-25%. I don't think there is any further downside than that. So I would really think that both from an absolute point of view and relative to other emerging markets point of view, 8,500 to 9,000 is really kind of a very strong bottom, fundamentally speaking. Technical, I don't have a view, but you can there are other views around technical analysis, but I just wanted to focus on the fundamental earnings based kind of support levels. So coming to what I was saying, how we have managed our portfolio, I think very clearly, given that our philosophy is growth at reasonable price, it has got challenged in the current COVID context. But we were very quick to realize in April what was happening. So in a lot of funds, you will see in our large funds like Equity P or even Focused or some of the other funds, we are sitting on large amounts of cash, almost 7 to 10% cash we still have. In our hybrid funds and balanced advantage funds, we have a lower level of equity than what is allowed, and that has helped us. So basically, one is to I think play on cash levels and have a slow gradual deployment of cash. The other thing which we have done is identified sectors which are going to be the worst impacted, which is on the left hand side of the table, and sectors which are benefiting or the least impacted. So obviously we have seen banks, SME lenders, retail lenders, capital goods, autos, hotels, and travel, and anything to do with discretionary consumption being the most impacted on the left hand side of the table. On the right hand side of the table, the sectors which are actually benefiting are pharma and healthcare, chemicals and agrochem because of the China plus one outsourcing benefit which will come to India. Telecom because it's such an essential service now. It is not necessary to, so among the basic necessities, telecom has become a basic necessity. In fact, there are stories that in Bombay, after the lockdown was removed, there have been queues outside the showrooms of the telecom companies to buy dongles and to get broadband connection, because everything is moving online and we need to have good bandwidth at homes. The other categories which are stable and have not seen much impact are consumer staples, general insurance, and life insurance also, where the demand, we expect the demand will pick up. and the last category is power and gas utilities. So what we have done is incrementally we have been reducing our weightage. We reduced our weightage proactively on banks and NBFCs and invested into the sectors which I shown on the right hand side apart from the cash. So that brings me to the other longer term things which I wanted to touch upon. One is the India over a 5 to 10 year period. I think we are staring at a huge opportunity to benefit from the current geopolitical situation which is arising given the US-China trade war. So it started with US-China trade war. Now with COVID and US elections coming up, I think the US-China relationship is going to get worse and worse. And I think given that kind of a Cold War kind of a situation which can be there for next 5-10 years, I think for India to emerge as the next manufacturing destination, I think it's a huge opportunity. We are already seeing chemicals and pharma where companies are benefited in the last 2 to 3 years. That could accelerate. Even government has become very active. Even states like UP have become very active in trying to attract investments. In fact, UP state government has set up a separate desk for companies which are based out of US, Korea, and Japan, US, Japan, and Europe to try and attract some investments into India. And I think the sectors where the action will happen is more on consumer durables, electronics, furniture, apparel, auto ancillaries. So the government of India is also giving a lot of incentives, production-linked incentives to attract these investments. Crude, I don't want to talk about. I think crude has become less of a factor. It's become stable, but anything in the $35 to $40 crude range is a huge benefit for India. And we've already seen that the government raised excise duty on petrol and diesel, and they've got about 1,50,000 crores as an additional fiscal boost because of lower crude prices. Now coming to the fiscal stimulus, as I said, I think what was disappointing was that the actual cash element of the fiscal stimulus was only 1% or 1.2%. And therefore, it is not sufficient for us to be lifted out of this earnings downgrade trajectory. But I think there are two or three things which were positive. First was on the agriculture reforms, where I think there are some really long pending reforms on Essential Commodities Act, as well as APMC Act and contract farming, which were announced. I think these are very significant announcements. And as it becomes clearer that there are more and more people which are going to be dependent on farm incomes till the time industrialization picks up, I think government has taken a pretty strong step. We also need to see how the execution happens at the state level, but I think this is a very important step. The second one was on the PSU privatization. Obviously, PSUs government has been trying to off and on an ad hoc basis make a list, but I think first time they've come out with a proper policy on what is a strategic sector or non-strategic sector, and even in strategic sectors they want to disinvest. So I think it's important because value as a segment, India has not done well, and most of the PSUs fall in the value category. So it will be interesting to see how soon the government can implement this, because we are also watching this carefully, because for us we never liked PSUs. We don't own too much of PSUs, but given that this kind of a move is happening with the government, I think PSU and the value PSU segment could start to do little better than what it has done in the last 2 years. In terms of in terms of the funds which therefore make sense in the current environment, I think obviously if someone is invested already 70-80% into equities, this is probably the time to be slightly more cautious and keep your equity allocation at about 50-60%. And therefore, if someone is over invested into equities beyond 60%, I would recommend shifting into either arbitrage fund or a balanced advantage fund. Our Balanced Advantage Fund, for Tata Balanced Advantage Fund, the model has worked very well because we look at not just the trailing P, but we also look at the forward P, and that has helped us in reducing the impact of the correction when it happened, because forward earnings were also getting cut. Our arbitrage fund is also top ranked fund across all time horizons, so you can have a look at that. The other category for someone who is looking to increase his equity allocation, and typically I would recommend anyone who is less than 50% into equities to keep taking advantage of each correction to increase that allocation towards 50-60%. I think the fund which makes most sense in the current scenario is the large and mid cap and multi cap category. I think equity P also will make sense, but equity P is typically a slightly higher risk, higher reward fund. So it does well when the economy is doing really well. So maybe this is not the exact right time to buy equity P, given that it might test your patience. But I think definitely it should be large and mid cap, followed by multi cap, followed by equity P. Should be the order in which the equity allocation can be increased if it is lower than 50%. So that is all I had. And then this is, I'll throw it open to Q&A if you have any questions on any of the issues which I discussed: market valuations, sectors, and the type of funds or equity allocation, anything at all. Please feel free.
Sure. I think we have got a lot of questions, Mr. Rahul. So let me start with the first question. Any schemes has been asked by Mr. Srinath Lakshman, which looks good in next 3 years horizon? Any equity scheme which looks suitable for the next 3 years horizon has been asked by Mr. Srinath Lakshman.
Yes, in a 3-year horizon, I think, as I said, the 3 funds which I mentioned, I think if you give me 3 years, then I would even put equity P little higher in that category. So I would put large and mid cap, equity P, and multi cap. I'm indifferent between the 3 over a 3-year period. But if you have a slightly higher risk appetite, then I would recommend equity P over and above over the large and mid cap and multi cap. Large and mid cap and multi cap are more all weather funds, whereas equity P is a value fund. So therefore, there could be more volatility in equity P, but over a 3-year period, it should deliver better returns than multi cap and large.
Great. Moving towards the next question. Asked by Mr. Pradeep Kumar, he is asking, is it better to continue our SIPs or lump sum investment in mutual funds in the current market scenario?
No SIPs, definitely no lump sum. I think, as I told you, that today the place where the market is today, the risk of downside is slightly more than the risk on upside. Given that my range for the market is between 8,500, 9,000 to 10,500. I think one needs to be at this point of time a little bit cautious. So continuing SIPs is much better than putting lump sum. If the market corrects 10%, then you can explore lump sum as an option.
Okay. Next question again coming from Mr. Pradeep Kumar, asking any schemes that cover agri reforms and PSUs?
Agri reform and PSUs in particular, we don't have a fund which directly looks at that, but I think there are 2 ways to kind of play on those themes, especially when it comes to PSUs, is on the value funds. So value funds as a category, it need not be our value fund, it can be value fund as a category, I think can do better. Our value fund is equity P, so that has exposure to PSUs. The other fund which will benefit on agriculture reforms is the consumption fund, because rural consumption is the one which had dipped in the last 6 months, even pre-COVID. If you look at 18 months back, rural growth was 50% more than urban growth. But 6 months before COVID, the rural growth had come down to as much as urban growth. I'm talking about the consumer staples here. So what we are seeing now is that the rural consumption will recover faster, number one. Number two, if the agriculture reforms are successful over the next 3 years, rural incomes, it's positive for rural incomes and predictability of rural incomes. So the best way to play that is through a consumption fund or a consumer fund.
Super. Next question coming from Mr. Jayesh Sule. He's asking, how do a retail investor react, or what he should do in such a volatile markets?
So the retail investor should look at, first of all, like I've been saying, he should look at his overall equity allocation. In the current scenario in the market, I don't see, unless you are a very high risk appetite investor, one should not have more than 60% in equities. And I think for someone who is 30% in equities, I think this is an excellent time to start buying and buy on every correction. So it really depends on what your current situation is. And also, I like to give this example always, that if you are a salaried individual in, let's say, travel industry or hospitality industry or aviation industry, you need to look at your equity allocation very differently from someone who is in a, working in a consumer sector, where the at least the uncertainty on the industry is much lesser. So you cannot delink it with your personal situation, and therefore I think it's very important to look at the equity allocation, like I said, 30%, 50%, 60%, where you are, and if you are working in an industry which is impacted significantly by COVID, then you need to be on the lower side of equity allocation, because you don't want to be taking too much risk on your investments when the industry in which you are employed is going through a troubled times. So there is no one answer for it, but I'm trying to give you a framework in which you can put in your own kind of situation and come to a conclusion.
Great. Moving towards the next question asked by Mr. Narendra Singh. He's asking, what do you think in these situations? Shall we do investments in index funds or index ETF?
I think if you look at last 1 year, and we were just looking at our own performance of our own funds, and only 10% of our funds have underperformed the index. The remaining 90% of our funds have outperformed the index. So I think what we saw in 2018 was a very special situation where nobody could outperform index. Today, we've got bulk of the fund managers who are outperforming index. So while I can understand that you can put 10%, 15% of your allocation into index funds or ETF funds, at this point of time, I am not very excited about the index fund. The reason being, the main reason being that 40%, 35-40% of the index is still financials. And if we are entering into a situation where the economy is going to recover very slowly, then financials will take time to fire, and therefore index will also take time to fire. But what can happen is that mid cap and small caps, which have underperformed for so long, remember that their underperformance started in beginning 2018. So they have been underperforming for 2 years pre-COVID. So therefore, I am indifferent today when it comes to mid cap and small cap, and I would say that traditionally, in a situation like today, when everyone wants to be more risk averse, you have a tendency to hide in large caps, but that is not necessarily the wisest thing today, because some of the mid caps, small caps, which have been performing, the valuations are quite reasonable. And as I said, in large caps also, the impact is felt across large caps. So it is not that a good company or a good bank is unaffected. And therefore, I would tend to think that this slowdown is very different. And therefore, in a COVID kind of a situation, I am indifferent between a large cap and a mid cap, and therefore mid and small can potentially outperform again over the next 2 years. And that's the reason why I would think that index fund and ETFs should not be more than 10% of your portfolio at this stage.
Great. Next question, interesting question coming from Mr. Noel Fernandez. He's asking, can you please advise students who are in college right now or probably will be looking after a job later on, how they can go for a strong, diverse portfolio one should have?
I think you have to choose. I think you have to choose a category which has a mix of everything. So if you're a student and you're starting just about starting, then you have to stick to one or two funds or one or two categories. You don't have to try too many things. And I would think that a multi-cap or a large and mid-cap category is what you should start with, because that has large cap safety, that has mid-cap alpha, because you can generate outperformance through mid-cap. And typically, those kind of funds will do reasonably well over longer period of time. So therefore, if you're starting your journey as an investor, I would strongly advise these two categories.
Great. Next question coming in. Considering the time constraint, we'll be able to take maybe one or two more questions.
Sure.
So coming from Mr. Chandramouli, he's asking, is it the right time to go for a tax saver fund? And does Tata Mutual Fund have any ELSS tax saver fund?
Yes, sir. We have a tax saving fund which has actually been reasonably strong performer. We have a Tata India Tax Savings Fund. It is a very old fund, so you can check that out. I think it makes sense if it's a closed-ended fund. You also have a security, in the sense that we also try and manage tax saving fund a little differently, because we know that it's a closed-ended kind of nature. The 3-year lock-in is there. So therefore, we have also we also manage it in a multi-cap manner. So we look at large and mid-cap, a good combination of large and mid-cap, which has worked for us.
Super. Now, many questions we are getting, how can we place order? So it's very simple and easy, viewers. As you can see, this is our website. You can log on to hdfcsec.com, or you can use our mobile trading app as well. So you can simply log into the application and you can go to the section of mutual funds. Right here, you have option of one time and SIP. You can click on it. Again, need-based recommendation we have given here, which has been categorized into aggressive, moderate, conservative, and tax saving. And if you want to know in detail, here we have download report option. You can click on it, and this has been recommendation given by our research team. So you can have a complete view on each category, whether it is equity, whether it is debt, whether it is hybrid in terms of equity hybrid or debt hybrid. All the schemes and the Tata mutual funds recommended schemes are also given here, which sir have just explained, right? And in order to place order, it is very simple and easy. You can go in any particular scheme, and all you have to decide whether you want to go for a one-time investment or you want to go for an SIP. And just after the scheme, you need to click on invest now. The option will come. You can just enter the amount, click on place order. Just in 2 to 3 clicks, your order would be successfully placed. So very well, you can do that. Similar interface from our mobile application as well, and a similar interface on our web portal as well, right? You can start up the SIP or lump sum as per your need. Okay. Now, many questions we have been also getting. People have joined in late, they missed out the session. So not to worry, viewers, the recording will be available on the same link after an hour's time. You can click the link, but open it on the mobile browser if you're watching from a mobile, or a laptop browser, that will be a Chrome, Google Chrome. You can watch the recording by entering the details. Right. So that's all for now. Thank you so much for joining. Thank you so much, Mr. Rahul, for joining in and giving such a wonderful, insightful knowledge level, which have actually, helped our investors, our customers to know, what are the markets looking ahead and how they can, plan for their investments. Thank you so much, sir, for joining.
Thank you very much for your time, and I hope you found it useful. As we mentioned, I think you can look at the recording. It had the presentation. So if some of you missed it, you can go through it again. Thank you very much, and stay safe.
Thank you, everyone. Thank you for joining. Signing off. Thanks. Bye.